Hi guys, welcome to Invest with George, where I look at company fundamentals, risks and valuation. Today we're looking at Peabody Energy, which is they're one of the largest coal miners in the world and in the US. The ticker is BTU. They have a market cap of $3.4 billion and an enterprise value of $3.2 billion. The company's shares bottomed in 2020 or 2021 when coal prices bottomed at a time where you had lockdowns, coal prices fell through the ground. But you also had this, the supply chain shock and massive liquidity in the global economy, and coal prices rallied back up, and so this is how the company's shares re-rallied, and they peaked in 2022, and have since kind of traded sideways to down as the coal prices have come down in value over time, and it's since re-rallied up due to the expectation of a bottoming in coal prices. So we're going to look at what the company's assets are, and we're going to look at what the company's valuation could be worth as well. So just a quick overview. Peabody Energy is a leading coal producer. It's got 17 mining sites across the US and Australia, producing about 140 to 150 million tonnes annually. It serves 26 countries, so it's got a wide customer base, but a large portion of that is Asia, especially from their Australian assets. Logistically, they're closer located to Asia. So China and India, and also Southeast Asia generally, are key buyers of coal, both thermal coal and also more importantly metallurgical coal, which is used for steel making. So Peabody produces thermal coal that's used for electricity production. It's kind of a dirty way of producing electricity. So in the West, there's kind of concern about what thermal coal prices are going to do in the US. But for China and India, it's still being used for electricity production. But like I said, more importantly, metallurgical coal. This is a more expensive coal, also called choking coal, and it's used in steel making. So it's used for steel mills. I think something like 70% of steel mills use metallurgical coal for the process of steel making, which is used for aluminum, for infrastructure building, construction, to roads, bridges, all types of infrastructure. It's heavily involved with steel making, and they depend on metallurgical coal as the fuel to heat up steel and to form it. Peabody is cyclically exposed to coal prices. At the moment, the valuation is relatively cheap. So for fiscal year 2026, which is next year, it's trading at a forward P of 10x, EV to EBITDA of 5, and a free cash flow yield of 10.7. The company has a very strong balance sheet, very low leverage for a coal miner, with a current ratio of 2x, a quick ratio of 1.14, and negative net debt of 200 million, which means that they have more cash than they do debt, which is very surprising for a mining company. And the company now, with their strategy, is to distribute returns to shareholders via aggressive buybacks. And the sell side recommendation is 5 buys and 1 hold. So as you can see, the company's earnings bottomed in 2020 when you had the massive crash in coal prices, and 2022 and 2023 were peak years for revenue and for free cash flow. They're expected to produce a negative free cash flow this year. However, in terms of profit, that's because they're spending a lot on capex for their new mine. Without this new capex spending for the new Centurion Mine, the company would actually be reporting free cash flow. So in real terms, the company is actually free cash flow positive. Even though free cash flow looks negative for the current year, that's because there's large capex spending. That is kind of one-off growth capex spending for the new Centurion Mine. But even as coal prices traded down, the company has done relatively well with maintaining a good amount of revenue and a good amount of profit. And the expectation is next year, or in 2026, you're going to have an increase in revenue from the new mine that they're opening up in Australia. So in terms of free cash flow, the expectation is that the company will continue producing positive free cash flow in a few hundreds of millions, and is going to be utilising this money for mostly for buyback. So this is coal prices over the last 5 years, specifically choking coal and thermal coal. So you can see choking coal is a much higher premium. There's less supply of it generally versus thermal coal, but the supply of thermal coal is more abundant, generally speaking, which is why the price is lower. And you can see you had this huge rally in 2022 and in 2021 because of the lack of supply, but also the fact that demand wasn't really waning. And then it's since traded down, these prices, but they're still stable. Like over the last few years, they have remained stable. And at these levels, the company's Peabody Energy's free cash flows are positive. And the expectation is if these prices have bottomed and we're at a multi-year low, then this could be a very positive development for Peabody, because they can utilise the free cash flow over the next few years at a $3.3 or $3.4 million market cap, and they can utilise that free cash flow to buy back shares, which will be a significant amount. And the reason why coal prices could have bottomed is because the supply of coal mines generally, there's not many new coal mines being developed across the world in these key locations like the US and Australia. So if demand remains stable, which generally across the globe in aggregate, because of Asia and demand coming from China and India, specifically India longer term, and the fact that you have relatively stable or peaking demand for thermal coal in the US as it's used for electricity production, there's no new supply, but demand is expected to remain relatively flat overall, considering all the different regions. And so therefore, that's why the expectation is that coal prices have likely bottomed or close to bottoming. And so that's a positive for Peabody Energy, who at these prices now are still generating free cash flow. So over the next few years, the expectation is the company can be using this free cash flow to buy back shares, and that could drive a material increase in EPS longer term. So key to this thesis on Peabody Energy as a coal miner is this new Centurion mine. It's an idle mine, but it's now being brought back to full production. It's a tier 1 hard choking coal asset. This mine is strategically located next to a port, which means that's a competitive advantage, because you have, if a mine is located further away from a port, shipping to Asia will be more expensive. So the closer you are to the port, that's a competitive advantage. It improves the company's overall margins. And so that's one of the benefits with the Centurion mine, and it's producing this premium hard choking coal, which is going for like $200 per tonne. And it's projected to be one of the lowest cost metallurgical mines globally, and that's thanks to it's got $1 billion in infrastructure base. It's got a 25-year life, and it's got reserves of 140 million tonnes of high quality coal. And India and Southeast Asia are key buyers of this type of met coal, and demand is struggling to keep up, and there's a scarcity generally for new premium coal choking products worldwide, and that's partly because of ESG pressures, where both asset managers investing in coal projects and also the companies, the producers themselves, also struggle, because typically what would happen many decades ago, and Monish Rabrai has talked about this, is that you'd have, if you wanted to go and build a new mine or develop a mine, you would have to go to the debt markets, or you'd do a combination of equity issuance and debt issuance to raise money to fund the development of the mine. That's now harder to do because you have the investor base, pension funds, insurance companies, so institutional and also asset managers themselves decide, because of ESG pressures, they're not funding these projects, so the companies have to self-fund. So in this case, Peabody is actually self-funding this project, so they're utilising their own cash on their balance sheet to go and develop this mine, which is a positive, and it kind of reduces the debt risk of the company. The number of people investing in these types of companies is less, which the company can benefit from, because if coal prices have bottomed and these companies are producing a lot of free cash flow and they're valued cheaply, well, they can utilise that free cash flow to buy back shares. But one of the reasons why there's been a limitation there hasn't been many new projects is partly because of ESG pressures. But longer term, it is making these higher grade coal projects more valuable. Management are expecting that the Centurion mine could produce 3 million tonnes annually, and at that level, based on this is a low price. I think at the current price, I think it's closer to $200 for Australian HCC, premium HCC. $500 million in revenue in the early years, and then peak revenue potential of 4.7 million tonnes, and that'll be giving you annual revenue of $846 million. And again, that's at a low price. The prices could go lower, but I'm just trying to be conservative. And after capex, the free cash flow uplift longer term to the group is 200 million. So based on the existing free cash flow the company generates from their existing mines, you're having a 200 million free cash flow uplift. I've also seen estimates of a 300 million free cash flow uplift longer term. So this is a key aspect to the company's thesis. And production for this mine is expected to start in Q1 of next year. Like I said, there's a lack of supply for premium met coal, and it's trading at a high price. So the company actually only produces. So the company, 50 to 60% of the company's revenue comes from the international market for seaborne met coal sales to Asian steelmakers. But overall, met coal only accounts for 20% of the company's production, but it produces over 50% of the revenue because of these high prices. So management are happy to increase their met coal exposure longer term. So this is why they're developing or redeveloping the Centurion mine. And in the meantime, they're utilising their free cash flow. So they're using 65 to 100% of their annual free cash flow for buybacks. which means it's a positive for shareholders. And because the company views their valuation as cheap, if the company's value stays cheap, well, that's a positive for us as shareholders because it will drive EPS longer term. And it depends on where share prices trade. It used to be a lower amount, so it used to be, I think, 65, up to 65% of the company's free cash flow was being used for buybacks. They recently increased it to 65 to 100%, mainly because they had a deal to buy Anglo America's coal mines. There was a fire at one of their mines, so they pulled out of the deal, referencing a material adverse change. The company was like, well, we have all this free cash flow. We're going to use the money in the free cash flow that we had to buy these assets from Anglo America, these coal assets. But now we're pulling out of that deal. We're just going to return the money to shareholders because we've got a good portfolio of assets. We're generating a lot of free cash flow. The company's shares are cheap. Let's distribute this money back to the shareholders. So this is the company's buyback potential, and just take this with a grain of salt because it depends on how many shares they can buy back at that price. So this is free cash flow for the different years. And this is in line with the sell side guidance, and this is based on using 65%, the midpoint, and 100% of your free cash flow for buying back shares. And this is saying if the average share price in 2026 is $30 a share, you can buy back 7.7 million. So if you're using 65% of your free cash flow and the average share price is $30, you can buy 7.7 million shares, and that will reduce the share count from roughly 121 to 114, giving you a free cash flow per share of 3. In the following year, if the average share price goes up to 40, you can still reduce the share count to 107, and that will drive free cash flow per share to $3.50. But I think the midpoint is a bit more realistic, and again, this is based on just assuming that the average share price is $30. We get to $3.2 a share in free cash flow, or 3.6 or 3.7. If you're using 100%, and these are realistic assumptions, you're getting closer to $4 a share in free cash flow per share, which again, for a company share price of 27, that is quite significant. So let's go and build a conservative model to see what Peabody Energy could actually be worth. So this is a DCF tool that I use to simplify the DCF process. You don't have to put in the exact amount of capex or the exact amount of net working capital change every year. It's just you put in your EBITDA and your free cash flow with certain assumptions to see what the company could be worth. The company's share count is 121.6 million shares. At the time of recording, 27.6 is the share price. The company has negative net debt, which is very surprising for a coal miner. Exit multiple, I'm going to use a 7 times EV to EBITDA multiple, being quite low because coal mining companies are typically not growing companies. And I think a 7 times multiple on EBITDA for enterprise value is a fair multiple. A discount rate of 10%, I think that is fair. Some people will probably use a higher amount because they think the coal mining industry is going to face a massive glut, and that thermal coal prices, production for these these coal power plants in the US, because that's expected to peak in the following years, that this is a bad thing for the coal industry. But actually, because there's a lack of new development of mines, and these mines have a limited lifetime, there's actually a positive longer term, and you have this demand coming from Asia and potentially Europe longer term. Overall, the coal industry is in a positive position. I know that's in counter-cyclical. In the commodity sector, it's supply and demand that affect the price, right? And so with a lack of new supply and demand being relatively stable, that is a argument for a bottoming in coal prices, so longer term. So I think that is a fair discount rate. Perpetual growth rate, I'm going to use 2%. For EBITDA and free cash flow projection, 450 and 550, growing mainly from the Centurion ramp up. And then I'm going to keep this in line with the sell side. So year one is really 2026. So I'm ignoring the remaining days in the year for 2025 just to simplify the DCF process. And I'm going to use 380, which I think is conservative. Then I'm going to use a 6% growth rate coming from a shift to met coal prices, which will increase the company's revenue. So if we go to calculate, you can see here we're getting an equity value of just under $5 billion. And that represents a roughly 40% intrinsic value per share, which is around 47% upside. So the way we're getting here is we're adding up the company's free cash flows. So the way DCF works is you add up the 5 years of the company's cash flows, which are down here. So these are the cash flows over the 5 years. You discount each year back by 10%. And then that's how you get this figure here, 1.5 billion, which is one of the ingredients for working out your enterprise value. But you also need to work out the terminal value. And there's two ways you can do this. You can use an exit multiple or the perpetual growth method. In this case, I'm using both of these methods, and I'm using the middle value. So for EBITDA for the 5th year of 655, times it by 7, which gives you a terminal value of 5.6 billion. You discount it back by 5 years, which is how you get 2.8 billion. And then for the perpetual growth method, you're taking free cash flow for the 5th year. You're giving it a perpetual value of 2%, which gives 5.7 billion. You discount that back by 5 years, and that's how you get 3.6 billion. And you're taking the midpoint figure between these two numbers, which is 3.2 billion. So you add 3.2 billion to 1.5 billion, which is what it's doing up here. That's how you're getting 4.7 billion. But because the company has more cash than they do debt, you need to add back this small amount of cash, this excess cash, back to the company's enterprise value, which is giving just under $5 billion in equity value. So if you divide that by the current share count, bear in mind this is very conservative because it's not even considering buybacks, you're getting an intrinsic value of $40 per share and percentage upside of 47%. And I think generally that is a bit conservative, like I said, because it's not including buybacks. If you use more harsh assumptions, so if you believe in these projections, but you think, okay, maybe a 5 or 6 times EV/EBITDA multiple is fairer, and a 1 to 2%, growth, perpetual growth rate is realistic, you can see that the upside is still in the 30s. Realistically, I think that the company's shares should be closer to $40 to $50 per share, considering these buybacks. And a big part of the thesis is if coal prices truly have bottomed and management can execute buybacks over the next few years with a cheap valuation, the company's share price could be anywhere between $40 to $50 a share. But always do your own research, guys, before investing in individual stocks. Thanks for watching, and I'll see you guys in the next video.